Hi there, Teresa Timms, president of TDR Mortgage and Real Estate Group in Upland, California, and you can find me on the web at thesocalloanpro.com. Hey, thanks for tuning in and welcome to my channel. Be sure to like, subscribe, and comment below. I'd like to know your thoughts, and if you have any questions, leave a comment and I will get back to you as soon as I receive it. I am sharing with you my 3 top tips when you're refinancing. I have a lot of clients that come to me during the process, before or after the fact, and really don't understand how to evaluate the refinance. How do you do apples to apples? How do you know you're getting a good deal? And one of the easiest things that you can do as a consumer is to look at your old loan and then look at the amount of the new loan, right? That's kind of like a no-brainer way to evaluate it. Now, keep in mind that your existing loan balance is not necessarily your old loan amount per se. So let's just say, let's work off a $250 amount. So if you look at your credit report or look at your mortgage statement, you owe $250. When you get your payoff, though, the interest that month that you skipped at the beginning, that's called interest in arrears. And so you're going to be paying that when you pay off your old loan. So if your loan balance is $250, you're probably going to be paying off somewhere around $252-ish, and then you get to skip another payment. Sometimes, if you structure it and you have enough equity, you can sometimes skip 2 payments. Keep that in mind when you're comparing apples to apples. So lender A, you're skipping 1 payment. Lender B, you're skipping 2 payments. Your loan amount is going to be a little bit higher with the lender where you're skipping 2 payments, okay? So now your new loan is coming in at $255. So if your payoff is $252, your new loan is $255. Logic is going to dictate that that loan costs you only $3,000. If you're saving $200 or $300 and you added $3,000 to your loan balance, let's say that's a pretty darn good deal. Now, keep in mind, if you got money back, or if you had to bring in money, you would also, factor that in. Okay, so that's number 1. Look at your old loan and your new loan. Number 2, super easy, no brainer. Do not look at the APR. APR is stupid. It's unregulated, it's manipulated, and it doesn't give the consumer the true cost. It does not give the consumer the true cost. It is 100% irrelevant information when evaluating a mortgage and the cost of a mortgage. Look at the lender fees. Just look at the lender fees. Don't look at the taxes and insurance. Don't look at recording. Don't look at the appraisal. Don't look at title and escrow. You're going to pay all that stuff anyway. That is irrelevant information to evaluate when you're looking at your refinance and how much it costs. You're going to look at the lender fees. Look at the origination. Look at discount fees. Look at loan processing. And look at underwriting or an admin fee, things like that. Those are items, those are your true lender fees. Those are loan costs, right? So a lot of times when I'm doing a mortgage, we're not charging underwriting, we are charging a processing. And sometimes we're charging a little discount to buy down the rate if it makes sense. I had a loan recently where it costs 1.1%. So if we're talking about a loan of $250,000, 1% is $2,500. And I went from like 4.1 down to 3.625. And it cost me a small amount. So that's super bang for my buck. And that was something that I recommend my client do. Now, if I'm just going from like 4% down to 3.8 or 3.75, that point is not usually going to pay for itself. So that's something that we recommend against. But that's a cost of the loan, right? An origination fee. Now, some lenders will charge an origination fee. So that's also a cost of the loan. So when you're evaluating your refinance, right? I have some notes over here, so I'm looking at those. So admin fee, underwriting fee, discount fee, origination fee. Look at that. And then the third thing to look at is your rate. What's your rate? Right? Lender A's rate is 4%. Lender B's rate is 4%. But lender A, your loan is $258. and lender B, your loan is $253. Well, if you just look at that, if you just look at those two things, you can see that, I forget which one it was, lender A or lender B, the one with the same rate but the lower loan amount, that's who you're going to go with. So I hope you've enjoyed these tips and found them very practical. Be sure to like and subscribe and comment below so that we can keep in touch in the future. And if you have any questions regarding a loan that you're going through, I'd hope that you pick up the phone and give me the opportunity to help explain things to you and meet or beat whatever it is that you're getting out there. And you can find me here. I was like, you can find me on the web, thesocalloanpro.com, and you can do that. But I'd love to hear from you. Pick up that phone and give me a call at 909-920-3500. Thanks for listening today.